We've definitely had some pain over the last few days, all starting with the Polish disaster, but that then turned into a retail sales disaster. What's happening in the markets? How does it change our outlook for the Federal Reserve? And are the numbers we're getting right now what we think they are? A sign that consumers are just still spending like crazy and the worst is yet to come from the Federal Reserve? Maybe. Let's break all of this down. So first, we got a very weak CPI report. I still pat myself on the back a little bit for nailing exactly the year-over-year and the month-over-month numbers, but this video is not to brag. This video is to talk about we had a good report. We should celebrate that together on CPI. Hopefully, that's the beginning of a trend. Then yesterday, we got a really good PPI report. So you've got the buyer's version, CPI of inflation, coming in lower than expected, still high, of course, and the seller's version, the producer price index level of inflation, coming in lower than expected. Okay, great, wonderful. And we've also seen that, obviously if you strip out shelter, you're at negative month-over-month inflation. We've been on that trend for about 4 months. If you just look at services from the PPI, we're at our first negative read since November of 2020. On a month-over-month basis, it was negative 0.1%. So those are great things. But this morning, things got screwed up a little bit with what looked like a strong retail sales report. And there was a lot of talk about, oh, nope, see, the consumer's still too strong. Inflation's going to go right back up in December. It is way too early to get excited about, that's it, peak inflation is in. No, the Fed needs to crimp even harder to crush that consumer and make sure they stop spending money. Because I'll tell you, the number of people signing up, and this is why I'm making all these videos while I'm on my cruise here, make sure y'all know it, because the number of people signing up for that Elite Hustlers course is really impressive. Y'all want to make more money. It's really, really good. Use that Black Friday coupon code, link down below. Black Friday is around the corner. But even people bundling up or emailing us for custom bundles at kevin@meetkevin.com, looking to build wealth in real estate or stocks, really incredible sign up. So yeah, the consumers are still spending, but not that I myself am a perfect example of a consumer spending gauge in terms of how many people are signing up, but it's worth noting. I think people are investing in themselves maybe, so maybe a little bit different. But we did get this retail sales report that was a little bit hot this morning, and we should touch on that a little bit. So this report, obviously, if you look at it from a year-over-year basis and you're like, oh, things are up retail sales are up 8.3% from October, the first thing you should say is, oh, well, come on, man, that's just inflation. Yeah, it pretty much is just inflation. But why then are we seeing stocks red across the board, but at the same time as we're seeing stocks red across the board, we're actually seeing bonds rally and bond yields are coming down, which is kind of interesting. So at the same time as that, we're also seeing the terminal rate for the federal funds rate on the market's projections move up about 10 basis points from about 4.83 to 4.93%. So kind of a little bit of a head scratcher. If these retail sales numbers are coming in hot, suggesting that consumers are still spending, then implies the Fed should have to raise rates more. We're seeing that with the Fed terminal rate expectations being moved up. Even Goldman Sachs moved their terminal rate expectations up another 50 basis points. So we're seeing expectations go up there, but at the same time, we're seeing the bond market rotate down. The inversion of the yield curve is the steepest it's been, I want to say, actually since the dot-com bubble. It was since 2000. I looked at that this morning. You look at the 10-2s. It's scary how deep the inverted yield curve is on the 10-2s. But those treasury bond yields continue to collapse. So if people really thought this retail sales report, which is hurting stocks right now, would contribute to the Fed hiking more, then bond yields should be going up. So it's a little weird. It feels like cognitive dissonance. And this is where I actually think that what the market is doing is something very, very different. I think, and then we're going to look at these reports, and I'm going to show you some supporting data. I think what the market is doing is it's saying we need to reprice stocks because these high retail sales numbers won't last. And now's the time to take tendies where there still are some to be had, if you have any left to take, or do some tax loss harvesting now, because earnings at these retail sale companies, any company that's selling stuff, probably going to start suffering. So let's get out while we still got an opportunity here on some potentially good numbers. Sure, does it mean the Fed potentially has to be a little bit more aggressive for longer? Yeah, maybe more aggressive for longer. But does it increase the peak in terms of how high the Fed is going to go? No, CPI and PPI put a lid on that. I think that's why we're seeing the bond market move down. People are saying, all right, look, now's the time, take some profit, do some tax loss harvesting if you need to, take some tendies if you need to on stocks. Let's move on over and hop on into bonds. Let's get what yields we can. We can get some great yields on corporate bonds, AAA rated corporate bonds in excess of 5%. You get some treasuries that are risk-free still at that 4.25% level. So some pretty incredible opportunities. So let's get out of some of these retail names while maybe this is the last hot report. That's sort of my thesis. Now, why do I think this potentially is the last hot report? And let's look at the actual report. Well, first of all, I don't think this hit as much coverage as it really should have. But remember, California just sent any household making less than $500,000 inflation relief stimulus checks. Yeah, I'm pausing here because you should be face palming right now. Like, you've got to be kidding me. But it's true. They sent stimulus relief checks in October to households in California. Remember, California has about 12% of the entire country's population. That means potentially 1 in 10 Americans got a stimmy check in October. That could actually help prop up some of the retail sales data that we saw in October, because it actually came as a surprise. We were seeing weak sales in September, and all of a sudden they popped up. Now, keep that stimulus argument in your mind, and now let's zoom in and see, okay, more stimmy money, got it. Where's money going on a month-over-month basis? Where are we seeing that increase in sales? Well, the biggest increase in sales we're seeing is gas stations, 4.1%. That's a huge part of this. Okay, not so much of a surprise, though, because prices became a little bit more expensive month over month, but they fluctuate so terribly. We always like to try to exclude those. But even if you do, if you exclude gas stations, we're still at that 1% read month over month. That's not so good. So where did it come from? Well, it didn't come from appliance stores and electronics. We already know that durables have been suffering. PC sales are down 19% year over year. We already know that. Food, yeah, food continues to be something expensive, 1.4%. Grocery stores, that's a big deal. Food services and drinking places, I know this one really well, 1.6%. That's a lot, but again, we know that people are spending more on going out. This is actually a good thing. We want people to go out and travel and spend money. It's a good underlying force for the economy. But we weren't expecting some of these numbers. But then again, if you looked at the airline reports, kind of like, okay, yeah, that makes sense. Still not seeing weakness in the airlines. Non-store retail, right here, 1.2%. That's like online. Personally, I think that's probably stimmy right there. That's probably your stimmy, because look where you're seeing the minuses. Department stores down 2.1%, sporting goods down 0.3%. And what's really interesting is, well, not only, of course, also seeing that decline in electronics, but you're also seeing building material and garden stores still puffed up. Look at that, 1.1%. But now, what's the other interesting thing about why this retail sales report could potentially be a peak bad number? Well, one was because of stimmy. But two, the lag effect. If non-store could be explained potentially by retail stimmy, what about that building material sector? And what are some of these companies telling us? Well, they're almost all telling us the same thing. Whether it's Best Buy, who's doing layoffs, FedEx, who's doing layoffs, and we're seeing cardboard prices collapse, Target, who's seeing $400 million in thefts, but also relaxations in their guidance. That's why they were down double digits today in the stock market. But what else are you seeing? Both Home Depot and Lowe's suggesting that all of a sudden they're seeing an inflection point and they expect weaker sales going forward into next year. A lot of this has to do with the fact that it takes a housing market slowdown to really start slowing down retail sales. So if you put all of this together, sure, we're going to have month-over-month gyrations, partly because of this massive stimulus check in California going, California is just so stupid. They don't teach financial education in the schools, so the state is run by people that obviously don't understand economics, and they're sending inflation relief stimulus checks. I mean, it's just completely pathetic. But you can't run against the governor. It's a Democratic mafia out there. Anyway, so, oh my gosh, what happens when you have companies and a housing slowdown suggesting that at the beginning of Q1 and the next few months going forward, we're expecting a slowdown? I think we're going to end up seeing a substantial decline in these retail sales reports going forward. That we might be in a position where this could be a peak retail sales report. And take a look at some charts here. You see consumers cut back as mortgage costs rise. That's not a surprise, but this is an interesting one. Consumption will be further hit from tight lending. Banks' willingness to make consumer loans plummeting. And usually when you see a decline in banks' willingness to make loans, you tend to also see retail sales trough right after that. We've already seen credit card spend go through the roof, as it seems like people are just trying to sustain for a little bit longer. I really think there's this disbelief that, oh, we can't be going through a recession. Let's just borrow and spend our way through it, and hopefully by then the Fed will U-turn and things will get better. So how do we put all of this information together in a simple summary? So my simple takeaway from this is this retail sales report, throw it out the window. The year-over-year numbers don't matter. The month-over-month fluctuations are in things that are totally skewed by energy, and if not by energy, they're totally skewed by stimmy effects, and they're not forward-looking, they're rearward-looking. But if you actually look at what's happening at companies, again, Best Buy layoffs, Cardboard down, FedEx freezing corporate hiring and laying people off, Amazon laying people off, wanting to hire less people for seasonal work, laying off people at the corporate level, Target, terrible sales guidance, Walmart saying more people are going to Walmarts to try to save money. You know, I think that's a good sales pitch, obviously, but it's interesting to note. And Lowe's and Home Depot both warning about the slowdown just now starting. I think you take this report, throw it out the window. When you take this report, you throw it out the window, what does it do? It says, in the future, we expect earnings per share at companies to go down for companies who are going to be affected by retail sales. Maybe, for example, a company like Tesla is saved because they might not be affected so much by this as long as they can sell every single car they produce. That changes, Tesla collapses. But it also reiterates to the bond market, hey, get the yields while you can, because that retail sales report isn't going to be what pushes the Fed to higher levels. It's going to be any kind of inflationary read, PCE, PPI, CPI, and so far, two really good reports pointing to the downside. This retail sales report, not very meaningful. Some of the insights are, I think it's a warning if you're exposed to retail stocks, and also if you're exposed to borrowing stocks, right? Transaction-based stocks. I was thinking a little bit about American Express, Visa, even SoFi or Affirm. What's going to happen when people finally say, you know what, I'm maxed out, I just have to pull the reins back? I think this is potentially a peak retail sales report, and it's a peak that is going to hurt earnings. So buckle up. Thanks for watching. We'll see you in the next one. Bye.